Picture this. You bought your first Aussie ETF. You're doing everything right, and then tax time comes and you realize you're being taxed on money that never actually landed in your bank account. If you invest $10,000 and it pays a $600 distribution, you can face tax on up to 5 different income types inside that $600. Interest, Australian dividends, foreign dividends, capital gains, and tax credits, even if you reinvest every single cent and never sell a unit. That's because most Australian ETFs are trusts that pass their taxable income straight through to you. If that feels confusing, that's completely normal. Nobody explains it when you buy. So today, I'm going to walk you through exactly how it works step by step so you stop overpaying. Now, why does getting this right actually matter to you? Because the difference between reporting your ETF income properly and rushing it is real money in your pocket. On a typical $600 distribution, correctly claiming your franking credits and foreign tax offsets can reduce your tax by $100 to $150 compared with misreporting, according to the ATO imputation and foreign income tax offset rules. Scale that across a $100,000 portfolio paying around $4,000 a year, and you could be leaving $200 on the table every year, roughly $6,000 over a 30-year career just from sloppy reporting. And here's the part most people miss. That's before we even touch capital gains tax. Here's the big one. Under current rules, if you hold your ETF units for at least 12 months, only 50% of your capital gain is taxed. That's the famous 50% CGT discount, and it's genuinely one of the best things Australian investors have. But from 1st July 2027, that discount is planned to disappear for most individuals, according to the 2026-27 federal budget, with gains instead taxed using an indexed cost base and a minimum rate of 30%. So if you're currently paying an effective 17.25% on discounted gains, you're looking at a jump to at least 30%, about a 74% increase in the tax rate on your capital gains. If you haven't thought about your sale timing before, that's not a failure. Most people never hear this until it's too late. So let's get into the steps that fix it. Step 1. Log into MyGov and link the ATO online service if you haven't already. Open your current year tax return and go to the Manage Fund and Trust Distributions section. It's usually under Income then Trusts. Your ETF distributions are pre-filled there, broken into trust distributions, capital gains, franking credits, and foreign income or tax offsets, according to ATO online services. Now, here's where I want to be honest with you. Don't just trust that pre-fill blindly. It's your starting point, not your final answer, and the pre-fill is often incomplete or late. We're going to verify it against the real source document in the next step, and that's where the money is. Step 2. Under the AMIT regime, that's the Attribution Managed Investment Trust System, your ETF has to attribute its income and cost-based adjustments to you at least once a year and disclose it on something called an AOMA statement, according to ATO guidance. Think of this statement as your tax Bible for that ETF. Open each one and match the dividends, capital gains, franking credits, and foreign tax credits against your pre-filled figures. If something's missing or wrong, you fix the tax return, not the statement. This is exactly the kind of check where an investor with an $80,000 Australian ETF found $2,400 of franked dividends carrying $1,029 of franking credits they would have otherwise missed entirely. And here's where it gets genuinely interesting. Let me show you how those credits work. Step 3. This is where the savings actually live. Take an $80,000 Australian ETF, paying you $3,600 if you just reported that as generic trust income at a 34.5% rate, you'd pay $1,242. But by entering the $2,400 of franked dividends plus the $1,029 franking credit, then subtracting that credit, your dividend tax drops to about $155 instead of $808, according to the ATO imputation rules. Same idea for a global ETF. You declare $420 of foreign income but claim the $90 foreign income tax offset, and your foreign tax falls from $145 down to $55. Franking credits are that uniquely Australian advantage most countries simply don't have. They offset your tax dollar for dollar, never ever skip them. Step 4. When you eventually sell, capital gains tax compares your sale proceeds. minus selling costs against your cost base. And your cost base is not just what you paid. It's your purchase price plus brokerage, then adjusted by the AMIT cost base increases and decreases shown on each AMMAA statement, according to ATO capital gains guidance. Reinvested distributions also lift your cost base because you've already paid tax on that income. So gather every trade confirmation from your broker and keep a running spreadsheet. One line per parcel. Get this wrong and you'll either overpay CGT or face an ATO correction down the track. The ATO online capital gains records tool can help you store it all in one place. But hold on, because the next step is where timing changes everything. Step 5. Timing is tax. Hold your units at least 12 months and you currently qualify for that 50% CGT discount. But here's the kicker. Say you plan to rebalance in 2028, selling units with a $30,000 gain, under current rules at a 34.5% rate. That costs you about $5,175. After purpose July 27 with no discount and a 30% minimum, it jumps to $9,000 and about $3,925 more for the exact same economic gain according to the federal budget and ATO rules. And I want to be upfront with you. This doesn't mean panic sell everything now. If you've got small gains or losses, or you'd trigger a bigger tax bill by bringing sales forward, rushing could hurt you. Also remember, capital losses can offset your gains in the same or future years, but they can't reduce your salary or interest income. Let that number sink in. A single $30,000 gain sold just one day after the rules change on 1st July 2027 instead of before could cost you an extra $3,825 according to the federal budget and ATO modeling. Repeat that kind of rebalance 4 times across a 30-year investing life and you're looking at over $15,000 in extra capital gains tax. For identical investment performance, the lesson isn't to panic, it's to be deliberate about when you realize your large gains. And now let me show you the 2 mistakes that quietly cost people the most. Now, the mistakes I see all the time, and if you've made these, you're in very good company. Number 1, treating distributions like free bonus cash and ignoring the tax hiding inside them. The biggest trap here is the distribution reinvestment plan, or DRP. Even though no cash hits your account, the full gross distribution is still assessable income and must be declared. According to ATO guidance, the reinvested amount simply lifts your cost base for later. People forget to declare it. Then get a please explain letter from the ATO, so if you're on a DRP, you still owe the tax this year. Set aside a little cash so a reinvested distribution doesn't quietly blow a hole in your budget. Mistake number 2, and this one's subtle. Confusing the capital gains your ETF passes through to you with gains from selling your own units. When the ETF sells its underlying shares, those gains get attributed to you as part of the distribution. Some are already discounted, some aren't, and your AMA statement tells you exactly which. In our example, $150 of attributed capital gains was simply taxed at a 34.5% rate, costing about $51.75 according to ATO trust taxation rules. The fix is genuinely simple. Just read the AMA labels and report each slice, Australian dividends, foreign income, interest and capital gains in its correct spot. Don't lump it all into one figure and hope for the best. Let's run it back quickly. Step 1. Pull your pre-filled ETF data from MyGov and ATO online. Step 2. Match every figure against your IMA statement line by line. Step 3. Claim your franking credits and foreign income tax offsets in the right labels. Remember, they cut your tax dollar for dollar. Step 4. Track your cost base, including AMIT adjustments and reinvested distributions. And Step 5. Time your disposals. Hold 12 months for the current discount and think hard about whether your big sales should happen before 1st July 2027. Do those 5 things and you stop overpaying tax on money you may never even see land in your account. If you've made it this far, you now understand something most Aussie ETF investors genuinely don't. How those 5 hidden income types work and how to stop them costing you. Your one action for today is simple. Download your AMA statements before you lodge and check them against your pre-fill. It takes about 10 minutes. Next up, I'm breaking down exactly how to use franking credits to potentially get a tax refund as a low-income or retired investor, including the dividend imputation refund rules, and that's genuinely one of the best-kept secrets in Australian investing. Remember, this is general financial information only and not tax advice, so always check your own IMA statements and chat to a registered tax agent or the ATO before lodging. I'm Sophie. I'll see you in the next one.